Good evening. Welcome back to video 3 of my series, Instructing My Wife in How to Manage Our Portfolio Should Something Happen to Me. Now, I've already gone over the big picture. So, big picture, we have life insurance. If I pass away, there will be a $1.2 million death benefit. And so she'll get that cash. And some of that is going into life insurance, but the rest of it then gets placed into a portfolio to generate cash flow. And the reason why cash flow is important is because the portfolio itself, $1.2 million, will not be enough, unfortunately, in this day and age. $1.2 million is not enough. Oh, my screen just went away. There it is. Yeah, so 1.2 million is not enough, unfortunately, for folks to live on in perpetuity. So she would be forced to get a job. By the time the children, like our child, well, we only have one child, but by the time our child turned 20, so in 20 years, is 1.2 million going to last 20 years? It doesn't provide a ton of income. If you go by the 4% rule, she's getting a little over $40,000 a year. That, with inflation, it's not going to be enough. It is going to be quite the struggle. We'll just put it that way. So I don't want her to struggle. So we want to build a cash flow portfolio. So cash flow is the blood of modern life. Yes, the US dollar is just a fiat paper currency, and it doesn't actually mean anything. It's just debt. It is literally debt, actually. So, and since the dollar's been taken off the gold standard, now we're just relying on faith that our government, which is being completely revamped financially by the Doge program, we're just relying on faith that our government is going to be responsible and pay off the debt that it does owe. So I personally believe that the stock market is the greatest democratization of wealth, and the markets in the US are extremely liquid. There's a ton of opportunity, and the fact that they now have index funds and ETFs that hold the largest stocks in the entire country, in the entire world, really, and you can own a piece of that and tie your well-being to the economy, basically. Instead of you just having to rely on your own two hands, you're also tapping into this entire network in the country of people that are all working to grow. That's orchestrated and organized by these businesses. And you can tap into that through the stock market. So that is a fantastic wealth creation tool. The stock market's also much more efficient from a time perspective. And when I say time perspective, I'm just comparing that to how much effort it takes to manage a portfolio of stocks versus how much effort it takes to manage real estate. So, yeah, if we want to compare stock market to real estate, you spend a lot less time on your portfolio than you will spend. Well, let's ignore people who are full-time traders. They probably spend more time, or at least the same amount of time, as professional real estate folks. But for the average investor, they're not going to be looking at the stock market for 8 hours a day. I personally built a trading system that was working for a while, and I was slowly growing it. And then I got married, and my wife was like, "We need to pay off our debt." So we paid off our debt, or a big chunk of debt. Anyway, all that to say, that trading system only took me 15 to 30 minutes a day to manage. And I can manage the whole thing from my phone. So I can be anywhere, do it at any time, anywhere, any place, as long as I have an internet connection and a phone. So, and you can be as active as you want with the stock market. Whereas with real estate, you definitely need to be on top of things because you have a very expensive asset in a house. It's very concentrated, large chunks of cash being dropped into a single asset without much diversification. And then you're managing that asset. And if it's a long-term rental, sure, you probably go months at a time without having to worry too much. But there's still quite a bit of risk there. So then real estate is a little bit more tax efficient than the stock market, but it's not dramatically more tax efficient. There are lots of, let's just put it this way, there are more ways to write off taxes in real estate than there are in the stock market. However, there are some very creative ways to avoid taxes or not have to pay taxes in the stock market if you pay attention. And then real estate. I used to think real estate was much easier to leverage, but then it's actually, I realize it's not very easy to leverage real estate because you have to convince a bank or a person to lend you money on real estate, and you have to find the deal, and you have to find a good deal that'll work, that they will approve. Whereas in the stock market, if you have a brokerage account, you can just sign up for a margin account and they'll give you leverage based off of how much equity you have. So you put $10,000 of cash in, a brokerage account will give you $10,000 of margin as well. So you can, if you use it responsibly, that can be very powerful. Now, it's not as much leverage as real estate, because with real estate, when you're buying a house, you can put 3% down. So let's say you put in $3,000, the bank will lend you $97,000 on the house. With a lot of strings attached, yes, but that is some crazy good leverage. So you're not going to get that kind of leverage in the stock market, but you can get leverage in the stock market. So, and then in the real estate and the stock market, you're building equity in both. And the way the cash flow portfolio works, it actually works very, very similarly to real estate. And the way I'm doing it, it's effectively focused on the same thing. I'm generating cash flow using leverage. That cash flow pays down the leverage, and then that cash becomes available to reinvest, or I can pull it out to cover bills. So I think the biggest advantage in the stock market versus the real estate is you can use a lot less cash to open up a position, whereas with a house, nowadays you need like $50,000 just to make the 20% down payment for an investment property. So yeah, that's a lot. Some places require a 30% down payment. So, anyways, so yeah, the amount of cash is much smaller with, you can do it in much smaller increments. And then the diversification is much greater in the stock market. So that's a little bit of a comparison between real estate and the stock market. Which do I prefer? Clearly, I prefer the stock market. And for my wife, just knowing my wife, she has owned a home in the past and she did not enjoy managing the property. It was a lot. And so I just don't want her to be worrying about or stressing about fixing up a property so she can rent it out. Now, we're going to be focusing on stock market positions and specifically cash flowing stock market positions. So that moves us to the stock market comparison of what do we put our money in when we're putting it into the stock market. So traditional stock investing versus cash flow investing in the stock market. These are very, very different beasts. There's a really good book called The Income Factory. Highly recommend it. I think it was written by Stephen Bavaria. I'll have to check that. But yeah, Stephen Bavaria wrote it. And he specializes in cash flow investing. And he explained the returns you get through cash flow can mirror the returns of a regular growth equity portfolio, as long as you are reinvesting that cash flow and not withdrawing it. So if you get 8% equity growth in the share price or an 8% distribution, you are effectively getting 8% either way. Now, I agree with him. That all makes sense. That's assuming that the price of your stock does not go down. So as long as that share price is remaining flat, if you get a distribution of 8% and your share price remains flat over the course of the year, yes, you gained 8%. And if the growth investor, their share price grew by 8%, but they did not get a distribution, same exact thing. So that's an easy way to compare. The tricky thing with distribution stocks, sorry, I keep losing my screen here. The thing keeps going away. So the tricky thing with distributions, when stocks make a dividend distribution, the share price drops by the amount of the distribution. So then that share, the shares of that company or that ETF or whatever, they have to make more money, and thus the share price goes back up in order for that share price to remain even. Fortunately, businesses and ETFs are in the business of making money, especially the active ones. And so that's not too much of a concern because they are generating revenues. So that is how companies sustain dividends over time. They're constantly making sales. Those sales bring cash in. They cover their operating costs. Whatever's left over goes to profit, and then they pay some of that as a dividend. Now, the cash flow that the portfolio generates in a cash flowing portfolio, that cash flow is its lifeblood. You live and die by cash flow. And this is true in all of life, actually. What happens when you lose your job? Your cash flow goes away. So you have to find another job. Or you have to find a rich uncle to mooch off of. Or you have to find someone or something that is going to pay the bills. So everything in life is about cash flow. And that has been one of my main focuses in investing my entire time investing in the stock market, which hasn't been that long, but it's longer than some. I've started investing in about 2014. So now, my focus on cash flow led me to options trading. And options generate tons of cash flow. And they're just basically insurance contracts on stocks that guarantee a price, and they give the buyer of the option a right to a certain price to buy or sell their stock. And the seller receives compensation for selling that right to the buyers. And then there's a predetermined time, so the options expire after a certain period of time. And then when the option expires, they look, see, okay, is the stock above or below the agreed price? And some people, they want it to be above the price, and they will take the shares and exercise that contract and force the person who sold that contract to sell them the shares at that price. Other people, if it's below that price, maybe they force the person who sold them the contract to buy shares for a higher price that they agreed upon in the option contract. This is all facilitated electronically and automatically. So no human is actually transacting any of the shares or anything. It's all now electronic. Now, individual humans can go in and make their own individual trades, but they're trading with market makers that are electronically managing their positions. So, yeah, it's all automated. It's super liquid. It is extremely safe if you are responsible and you know what you're doing. If you don't know what you're doing, it can be very dangerous. So, the basic idea is that I had was I could use options, learn how to sell them responsibly, and use that to create cash flow in my portfolio and effectively become the insurance company on stock prices. And I've been working at learning how to do that for years. And like I said before, I developed a trading strategy. I'm not going into that strategy in this video. That's way too involved, and my wife would not appreciate that. So instead, we are going to be outsourcing that strategy to an ETF that specializes in options trading. So the revolutionary thing is now, within the last 3, maybe 4 years, they had a change that the SEC made to the rules, where now ETFs can create funds whose sole objective is to generate cash flow through options trading, various different strategies. And these strategies, some of them involve the broader market indexes, like the S&P 500, the most popular, the NASDAQ, the small cap stocks, the Russell 2000, and then some of them involve much riskier plays like Tesla, MicroStrategy, you name it. They've got tons, and the Yield Max especially, they have tons of single stock trades where they're literally running a covered call strategy using options to create cash flow and then paying that cash flow out to investors on a monthly basis. I think now they pay out every 4 weeks. So they have competitors, Roundhill, who are paying on a weekly basis. And I believe YieldMax did switch to a weekly payment with their YMAX ticker. In any case, these companies are effectively running extremely similar strategies to what I was doing. And what I realized as I was studying them, not only are they running very similar strategies, their cost to manage the portfolio is dramatically lower than my costs were. My costs, I would spend probably about a little over $1,000 just in commissions over the course of a year. And that's like I was just placing lots of trades, and I made some money, but I was watching a lot of my money go out the door to commissions. And then you have losses, and as you're working on figuring out a system that works, those losses really eat in, and the commissions really eat into your profits. And so I wasn't really seeing, I was matching the market basically, and that is very depressing when you match the market. Like, I'm like, oh yeah, I managed to get my portfolio to go up 10% this year. Oh, the market went up 10%. Okay, that is depressing. Now, these guys, they have a much higher expense ratio than a typical ETF. But with a 1% expense ratio, you put $10,000 into a portfolio with a 1% expense ratio, and you're only spending about $100. So that's 10 times less than the commissions that I was spending. 10 times less. So, yeah, that's a pretty good deal. In any case, they can do all of the complicated options trading, and then we simply park our money with them, and they do all the work. And then every 4 weeks, or every Friday, if they're paying weekly, we collect a dividend check, a distribution. And that distribution comes from the options contracts that they've sold and any capital gains that they generate through their trading. And then that distribution comes into the brokerage account. That's cash that we can now use for adding to new positions, reinvestment, or withdrawing and paying bills. It is not very complicated. The whole process itself, from the investor perspective, is very simple. But understanding what they're doing under the hood is quite complicated. However, we do not want to overcomplicate things because I want my wife to be able to simply focus on allocating cash and generating cash flow for herself to cover the costs of our children. Well, if we have more children, but to cover costs of our child and herself. So, if I do the math, let's see. So, I would like her to put the most of the money into a life insurance policy. And so, let's say $1 million is going in over 10 years into a life insurance policy. And in year one, she has access to $200,000. So in year one, 200,000. Hold on a second. So if we did, we'll just do $1 million. There we go. Let's say she puts the $1 million to work. Yeah, she can generate $200,000 by allocating that to several different positions that pay, several different ETFs that pay 0.2%, or no, 0.2, so that's 20%, sorry. So, yeah, that would generate $200,000 a year for her to cover her living costs. And each year, she can pull money from the portfolio to pay the life insurance premiums, or she can pull the dividends to pay the life insurance premiums. Either one. Yeah, either one's fine, actually. That seems a lot more palatable than her scraping by off of my original plan, which I was just thinking, the $1 million goes into life insurance, and we do a cash rider where the premium deposit fund. So $100,000 into the life insurance, $900,000 into the premium deposit fund. But premium deposit funds only pay about whatever the Fed rate is. So this would generate much more cash for her. And if she wanted to be super conservative, she could put it into one that's paying a 12% annual. So that gives her $120,000. So yeah, she could be generating anywhere from $120,000 to $200,000. And if she wanted to be aggressive, she could get up to $300,000 or $400,000 a year. So that's all possible with options. And the beautiful thing is you don't even have to know how to do options yourself anymore in order to take advantage of them. Now, it is good to learn about options just so you have an idea of what's happening. I wouldn't recommend, in fact, no one should ever invest in something that they do not understand. But I do understand options. So, now for the cash flow strategy, she would have to set and pick her own cash flow targets. I think I'll do a few videos, I think I'm going to do some follow-up videos to outline potential ways she could set up the money. Just give her a few different options and she can allocate how she feels comfortable. And that could be an interesting video. But and then over time she wants to diversify that cash flow. And so as she's getting that $200,000, let's say $50,000 goes towards giving, live off of another $50,000, and that leaves $100,000 to reinvest. Well, and taxes. So $50,000 of taxes, $50,000 giving, $50,000 reinvest, $50,000 live off of. So the amount that gets reinvested continues to compound, and she can pick alternative investments to put it into. So if she wants to buy a house, she can use that for a down payment. If she wants to, I don't know, put it into something else like the S&P 500, just the straight up index fund, that's also possible. I would want to increase dividends until she has much more, like much more, like very comfortable. And $200,000 sounds comfortable, but inflation again, that's still happening. So, and then once she's comfortable with the cash flow, then any excess cash flow goes into purchasing just straight up regular old boring indexes, and that locks in equity growth plays. And so as that grows over time, that will create more margin space, and the whole account value will continue to grow and accelerate more and more and more. So So once the cash flow need is met, you don't really need much more. And this is not advice for anyone except my wife. And well, thanks for watching this video. I don't know what else to really say. I think that just about does it. If you like this topic, feel free to subscribe for more videos. I think I'm going to work on the next video. I'm going to look at outlining a sample portfolio for my wife. So right now we're trying to hit $4,000 a month with our existing portfolio. But our existing portfolio is very aggressive and requires a lot